Okay, guys, thank you all for joining us today. Today's conversation is coincidentally very timely considering everything that's been going on this week with the rise of DeepSeek and the impact that this has had on financial markets, particularly AI and tech sectors. So with that said, we're going to be jumping into discussing in more detail the topic of unlocking diversified returns, and we'll touch on how equal weighting and AI can help mitigate some concentration risk that we see in the market today. So before we get started, my name is Rebecca Wild. I will be the moderator for today's discussion. I am the managing director here at StockSnips. And if you are new to StockSnips, we build active AI-powered model portfolios and ETFs. We will touch on that further in the conversation, but I'm pleased to introduce our guests for today's discussion. We have Ravi Koka, founder and CEO of StockSnips. We have Satya Pradhuman, CEO and director of research at Cirrus Research, and Mike Akins, founder and CEO of ETF Action. So Ravi, I'll quickly pass over to you to start us off with a very quick introduction and brief touch on your background.
Thank you, Rebecca. I'm Ravi Koka. I'm the founder CEO of StockSnips. Primarily a computer and AI scientist, and also an entrepreneur. This is my third venture, and my specialization has been in natural language processing, which has evolved into large language models, and I've been around AI for over 3 decades.
Satya?
Yeah, I'm the director of research here at Cirrus. We focus on the institutional investor market. We are a macro shop. We focus on the classic sectors, industries, factors. We build a lot of custom portfolios as well. And so, yeah, this area is the market space is really what we comment on.
And Mike.
Yeah, great to be here for everybody today. My name is Mike Akins. I'm the founding partner at ETF Action. I've been in the ETF space for over 20 years now. I was the head of ETFs at a large mid-sized issuer here in Denver, Colorado, since the early 2000s. In 2018, I started ETF Action, which is a data analytics platform. We provide in-depth analytics on the ETF space, help advisors to use those ETFs in the development of model portfolios, and support really the overall ecosystem and growth of the ETF marketplace. I think big picture, if you look up ETF nerd in the dictionary, there's a picture of me next to it.
Awesome. So I want to kick things off, guys. Well, I'll try my best not to spend too much time looking back at 2024, but it was certainly a pivotal year for AI. We saw the tech sector, particularly the Mag 7, lead the market with average gains of over 63% in 2024. So quite incredible. This accounted for more than half of the gains of the S&P 500 in just those 7 stocks. And it now makes up, over 1/3 of the S&P 500 index, at least as of the end of 2024. Lo and behold, this week we've seen, a lot of disruption with the rise of DeepSeek, really causing disruption through the whole AI-driven market rally. So Satya, maybe I'll let you lead off. If you can unpack that point a little bit more, what is this AI phenomenon that we've seen over the last few years, and maybe the impact it's had on the thematic space?
Sure. NVIDIA as a standalone stock has really dominated markets, conversation, and everything around. Since really spring of 23, you've seen the rise. The market, I should say, has really put focus investment dollars into this space. I think Mike will go through even more detail than I will. If you step back a little, however, the question is about, does this latest unfolding of DeepSeek, this announcement really change the themes? And in many ways, I don't think it does. To some degree, the downstream effects of AI are underway. And so, for instance, when you look at the ability, if you were to take a large language model and apply it to a business, there's a ton of work that needs to be done internally at these firms to organize, manipulate the data, get it ready for these tools. So the second order spending is coming. And so the nuance, though, is this idea of, should we all plow into NVIDIA? From an equity portfolio stance, doesn't make a lot of sense. But part 2 to this is that the spending patterns that's coming suggest that there is change underway. I have a couple of quick charts I could show you that I think it's kind of cool that kind of gets missed. So this chart is about the financial sector in 24. I know we've just talked about NVIDIA, but did you know smaller investment banks were up 52%? The large financial sector was up 36%. So it's underneath why active portfolios, some active portfolios and active baskets have done well without just owning NVIDIA. Part two, you've had 4 years of industrials continue to outperform in small cap land. Industrials for 3-4 years have done very well in large caps as well. What I'm getting at is that this market is broadening. And yesterday is another example of the sort of like ripple effects of investors being too focused in one area. So I think this is a big deal, and it's a wonderful opportunity to think about how we run active portfolios.
Yeah, awesome, Satya. And maybe Mike, I'll pass this over to you, obviously, with your experience in the ETF space and now with your tool. You know, how has this developed since the start of, you know, your exposure in the industry? Perhaps you can demonstrate a few trends we've seen in the ETF or thematic space over time.
You bet. So, I mean, big picture, I think you laid out the discussion point here a lot, right? We're looking at a Mag 7 or top 10 weighting in the S&P 500 that's gone from 17%, meaning the top 10 names in the S&P 500 10 years ago made up 17% of the S&P 500 to over 37% at the end of 2024. So a massive concentration. You laid out what that means from a dynamic of contribution to return for the major indexes. You know, to further state that, the last couple of years, we've seen significant underperformance in beta type equal weight versus market cap indexes. And I say beta, meaning they own the exact same stocks, they're just equally weighting it versus market cap weighting. We've seen significant underperformance where historically equal weight has outperformed over full market cycles, right? So we clearly have an interesting dynamic going on in the marketplace. And I think that if you talk about AI and DeepSeek, and a big part of that is playing into this, right? It's that huge trend of innovation, technology-led innovation that these largest firms are participating in that are driving the rest of the market. Now the question is, are we at an inflection point where they've laid the groundwork for the other firms to start benefiting? And I think really that's where we're at. So a couple of data points from my perspective, rather than talk, you know, purely macro here, just to give you an idea of how much the money is kind of driving the narrative here. If you look at the sector and industry ETFs, right, there's several hundred ETFs just focused on specific US sectors and industries of the market. They've got about $750 billion in those ETFs. Last year, they saw $28 billion in inflows. Almost 100% of that was to the technology sector ETFs, right? So the part of the story here is being driven by the flows of the money. The investors are choosing to invest in this. The market is just a weighing machine. It is a supply and demand concept. And to the extent that the money is flowing into technology, those names are going to outperform. That's how the market works, right? So it's short term, you know, it's sentiment, and then longer term, it comes down to break out of those fundamentals. Further, if you look at that, you can break that into growth versus value. You know, the overwhelming amount of money has gone to growth. And my final point on that is you know, we classify. I'm in the business of classifying everything, right? I'm a data geek. I classify everything, and I classify the S&P 500 as a U.S. equity large cap blend portfolio. But in reality, it's not. The U.S. equity large cap portfolio today is a growth portfolio because of what those statistics we just talked about. The names that are making up the largest concentration of the S&P 500 are growth names by any measure. You know, whether you're looking at valuation to determine growth, whether you're looking at growth metrics themselves and sales, earnings, things of that nature, no matter how you look at it, the overwhelming weight of the portfolio is in growth. So everybody is upside down. So what do you do, right? And I think that's why I'm excited to join today's conversation, is because investors, especially financial advisors, are kind of in a rock and a hard place. They recognize there's a situation going on where we all investors, intentionally or not intentionally, are overweight a small subset of the market, a small subset of names in a significantly dangerous way. Historically, that told us, you know, this can't last forever. But how do you make those changes without significantly underperforming the broad indexes if this continues for a while? I think that's really where this kind of conversation really evolves, and I'm excited to participate in it.
Awesome. And Ravi, I want to ask you, obviously you have over 3 decades of AI experience, so you know you're extremely well versed in this area. There is a segment of the market that's emerging, which we are in the business of, which is AI powered investing. Can you differentiate for our audience who are joining us the difference between AI investing in stocks such as Broadcom, NVIDIA versus AI powered investing? Can you help us unpack that, please?
Yeah, like, you know, I think what Satya mentioned is this whole thematic that has emerged. Anything that is related to AI, whether it's infrastructure or whether it's software or NVIDIA, which represents the chips that are used in AI, and people are looking to saying, how do I get a piece of that? A lot of advisors say, hey, or their clients are calling and saying, how do I get a piece of this rally, right? And now there's the other thing that both Satya and Mike touched upon is this concentration that has happened. And what's interesting, for example, is the fact that in spite of the fund flows into the technology sector, if you look at Satya's numbers, it's showing that the financials have done very well in last year. So this is where I believe AI comes in, is that AI is able to recognize patterns that are nonlinear and non-stationary, that the markets are constantly moving. I mean, you think it's technology today, it could be financials tomorrow. And AI-powered investing means that you're using various AI techniques, be it natural language processing or machine learning, to discern these patterns so that your allocations are more adaptive and responsive to changing market conditions. That is what we mean by AI-powered investing.
And
Rebecca, I had
Yeah.
one thought based on what Ravi said. There are two things to think about that drives markets, and we really need to get back to grounding. It's earnings and it's earnings growth and the acceleration, I think, of business. These two pieces that came out recently, I think they're really neat because they say a lot. So NVIDIA is about a $3 trillion company, right? If it were to accelerate at the near 200% level on top line growth, it'd be greater than the US GDP in about 2-3 years. So there's a little bit of gravity running here that we got to respect. But importantly, what this shows is the top line growth has been slowing steadily the last few quarters. I doubt it's going to change in this upcoming next month when it reports. It's going to continue to slow. Part of it is a law of large numbers. That said, spending is going to remain strong. But we talked about financials, and this is also very important. This shows large and mid-cap banks. Loan growth data in the US is now starting to stabilize and reaccelerate. The forward year estimates have begun to accelerate. This ties back to what Ravi is saying, which is at the end of the day, a good active portfolio should sniff out where business is going, where the puck is going. So
Yeah.
I think you're exactly right, Ravi. The tools, whether it's a fundamental analyst or the mathematical approach, either way, you got to be able to focus on what's driving the business growth.
And with that being said, Satya, maybe you can, shed some light into what macro trends you think are going to impact this year ahead in 2025.
Yeah, I mean, I think the critical trend in our Outlook report, and by the way, that's out there on a podcast and our YouTube channel. The big thesis is that the spending in the AI vertical will remain. We do believe, though, that it becomes more diversified, that it has to go further downstream. As I said earlier, in order to get these applications to become monetized, you got to sell something. You can't just buy chips. So the question is, what happens next? For businesses to put these tools to use, there's a tremendous amount of reorg that's got to get done in terms of data infrastructure. So there's lots of companies in that food chain that are now starting to act better, right? And so it's also post a couple of years of a bear market in smaller technology and software technology. So I think that is important too. This market's broadening. You've got a credit expansion cycle that started about 18 months ago. Globally, we've seen credit spreads rally in sharply. That's great because it means businesses have cheaper money. And as a result, it does seem like the financials work. Part two of this is that we can debate DeepSeek's ability to disintermediate energy needs. I think if you take the applications as they roll out to real industry, we are going to realize that we need a ton of additional energy. So these industrial spend that we've made a case for the last 3-4 years on infrastructure, it's done very well. This AI component just accelerates that on top of the EV spend globally. So there are plenty of themes to be focused on that's allowing this market to broaden. The sell-off the other day basically said value and small caps did better. That's a broader market. So you're going to get these hiccups. And then finally, the note on NVIDIA is that this is very normal for an expensive tech stock, right? They're going to be, developments, whether it's more efficient software or competitive hardware, that's going to create ripples in the water. The only reason something's going to correct by 10, 20% in a day is because it was probably expensive in the first place. So that is something that's driving this idea about your diversified equity portfolio.
And Ravi, there's so much information out there now for financial advisors specifically who don't have, heaps of research analysts to try and ingest and make sense of and predict what's about to happen. Do you foresee, obviously, with your exposure to AI-powered investing, do you think this will play a larger role in this coming year in responding to some of the macro trends like what Satya's just mentioned?
Yeah, I mean so the question is you have to poll the market environment, right? So what AI does is to sample various market data, and what is unique about what StockSnips is doing is that we've added another variable, which is the investor sentiment and beliefs, and we've quantified that and come up with a measure which we call it's a proxy for investor sentiment. And it's a great use case for AI because with the algorithms we have, that we've trained to read and understand financial media articles, we are able to ingest 50,000 articles a day and be able to attribute them accurately to all of the US equities and tease out this proxy continuous measure of investor sentiment. And with the volatility you're seeing in the market, like what you saw with DeepSeek, you're going to see shift in investor sentiment and beliefs, and that's in the short term. It's short term. Long term, as Satya says, fundamentals, earnings growth, that's where it's going to settle. But in the short term, investor sentiment is a trend indicator, and I think that's so using sniffing that out and using that to adapt your portfolio is kind of the value we deliver with AI powered investing. Or I should say, that's the potential for AI applications. And I do agree with Satya's comment that this AI investment is going to broaden across not just the chip manufacturers, but all of the application vendors, the software companies, and even services companies that have to go out and help enterprises and small businesses to set up the infrastructure to leverage this, just like what happened, with the internet. There's a lot of, everybody has a website now, right? So that's what you're going to see. You're going to see wide variety of large language models used, by small business, large enterprises, etc.
And I think it's safe to say kind of the AI-powered theme of investing is introducing much more active type of strategy. Mike, from an ETF perspective, US ETFs broke everything in 2024. We saw record high inflows, new launches, AUM crossed 10 trillion, crypto burst onto the scene, and active management certainly exploded in popularity. What do you think advisors should be aware of as we head into maybe 2025 in terms of ETF trends and also ETF allocation strategies?
Yeah, so excuse me. The first thing I would say is the recognition that the ETF structure is undefeated, right? And I think that's the biggest driving factor here is simple reality. It's more efficient to trade. It's more liquid. It's more decision driven. It's more tax efficient. The costs are lower. So the structure of the ETF is the biggest story here in terms of flows. So I always try to warn people, don't get too caught up in seeing headlines of $1 trillion in rolling flows into the ETF market, because a lot of that's coming directly out of the old mutual fund market, right? So you have to parse the noise when you start thinking about macro trends, to not just look at the top line number and kind of go through to some of the more mature areas. So from a macro perspective, looking at the ETF growth market, I think first and foremost, we're kind of in this this environment of two markets, where you have the boomer market that is risk averse, and we've seen massive growth in risk averse type of strategies, whether it's buffer ETFs, whether it's synthetic income ETFs, and of course that's for people that are looking to participate in the markets but are giving up upside in return for less downside. Historically, those strategies are going to significantly underperform the market. And as long as your investor base knows that, it's great. It's kind of why I think of it as a boomer investment. These folks are not looking for as much return. They're looking for a little bit more protection. And the flip side of that is, so that's a ton of flows have gone to that. the rest of the flows in a big way has gone into more of like the YOLO market. You only live once concept of leverage, into very niche strategies focused on very high growth areas of the market, single stock type concepts. So you've seen this really interesting breakdown. At ETF Action, we work primarily with financial advisors, and our job is to take that and throw it away and let you kind of work through into the actual market, get back to the basics here. And I think when you look at that perspective, active is definitely a big story to be told. Now, I would argue that active has been around in the quantitative style for a while now, right? So there's a lot of ETFs that are very active in terms of turnover, in terms of changing their names, changing their sector allocations based on a strategy. But now we're seeing the large active managers, T. Rowe Price, one of the largest asset managers in the world, John Hancock, MFS, Capital Group. They're all coming into the ETF market. And the reality is it's coalescing around the simple fact that the strategy is better. And it's a good thing. You're now getting access to good managers at lower prices, but now it adds the complication of having to go under the hood, right? And the beautiful thing with the ETF is you can actually go under that hood. So I would expect that we'll see kind of two key themes play out this year. Well, maybe three. But the first and foremost is I would expect that the largest beta strategies out there, the S&P 500, IVV, VOO, SPY, QQQ, you know the names, the tickers that are going to continue to get their lion's share of flows as both people come out of their mutual funds into the ETF market, as required minimum distributions come out of 401k plans, and they have to put it in, they want to keep it to work. It's going to find its way into a lot of that. But then if you kind of go into the second side of that, I think you're going to find a lot of allocations in the non-beta space, the non-composite. It's going to be broken out into two areas. The active managers, right? There's been pent up demand from a lot of financial advisors that I talked to that wanted to get active management in the ETF wrapper at a reasonable cost. And we're seeing that in numbers, right? Record numbers of active ETFs launching, record amounts of flows going into those active products. And the other side, I'd kind of put more in, what we're talking about here today is I think you'll continue to see advisors looking for. We have conversations all the time with advisors that are looking for ETFs as a tool to help them with problems such as concentration, right? To help them navigate the market in a better way. And really, I always say you kind of have a handful of ways to build a model, to build a portfolio. You can buy it, right? That's the beta. I can buy ACWI, I can buy AG, I can weight it based on my risk profile, and I own the market, and I rebalance once in a while. It's super simple, super efficient. Nothing wrong with that, but that is, anybody can do that in 2 clicks of a button. You can build it. You can go through one by one and say, I like this sector over this sector. I like this factor over this factor. I like this country over this country. And you can go through and manage it. That is an extremely a lot of work, right? So to do that takes a ton of effort, takes a ton of research, and there's no guarantee you're going to get it right. Or, and kind of what we work with most advisors on is you can pair strategies, right? Kind of the old hub and spoke model where you have your core, you have your allocation to the market, but then you're looking to add a handful of vehicles that will help you navigate it. I am a big believer in letting the vehicle navigate for you. So finding the strategy, whether it's a StockSnips sentiment-driven strategy paired with a value strategy, paired with whatever it may be, but finding a strategy that helps you navigate for you. And I say that for a couple of reasons. One, because you're letting a professional with a professional process do that for you. But two, being an ETF guy, trust me when I say having high turnover inside of an ETF is a fascinating tool compared to having high turnover where you're doing it yourself. The tax implications of being able to quickly reallocate your portfolio from financials to technology to large cap to small cap inside of an ETF, and I won't get into all the geeky details of why it works, but you can know that doing it inside of an ETF is going to lead to superior after-tax returns every day of the week and twice on Sunday. And I think that's the piece of the market that we're going to start seeing grow is these strategies that help you navigate your tilts within your portfolio. So if you want to tilt away from the Mag 7, if you want to tilt away from the massive allocations, you want to do it into strategies you think are going to outperform so that you don't, in case tech continues to lead, in case the Mag 7 continue to lead, you need to keep up in order for your portfolio not to fall behind the benchmarks. But you can do it in these vehicles. That's a much more efficient way and let the decision of that manager or the decision of that algorithm leads you to where you should overweight your portfolio to reduce some of those concentration issues in your core, which would be the S&P 500 or the MSCI EFA or whatever it may be.
Mhm. No, I absolutely agree with that sentiment, Mike. I mean, we speak with advisors daily, and it's a very similar outlook in that they are looking for ways to obviously differentiate. They cannot do active stock picking that well. You know, the S&P 500 has humbled many individuals in this industry for a long time now. So I think being able to gain access to some of the top fund managers in the world via the vehicle of an ETF, it is quite a profound transition that we're seeing, specifically as we look more into the active space. Now, Ravi, we're obviously in the world of, active strategies. We do something slightly different. However, a lot of the active strategies that exist today are looking at fundamental factors, slice and dicing it in a, somewhat of a unique way. But here at StockSnips, we have created what we believe to be an alternative factor, which is sentiment. So over the past 8 years, for anyone that's kind of new to us, we've built an AI-powered platform. We read over 50,000 news media articles a day to determine which equities are trending in sentiment. So Ravi, maybe you can enlighten us. What led you to this hypothesis of what people say about stocks, and how does that drive price? If you could unpack that for us.
Yeah, my previous venture, which I was lucky to list on NASDAQ, I took an IPO, and we went through the late 90s, early 2000, the boom and the bust, right? I mean, it was really the markets were frothy, and that's when I realized that the stock market, when I started looking at valuations, I knew that it was not the fundamentals. You could not justify the prices, including my own company's stock. Within 3 months, we went up from $7 to, $35. I mean, a huge increase, right? And that was not justified by fundamentals. So I kind of knew that we were in a new era with the whole growth of the retail, or what is called the rational investor versus the rational investor. The market's made up of, it's become inefficient, as Cliff Asness recently wrote, the inefficient market hypothesis. So that's when I realized that there's something going on, and given my background in natural language processing, and there was actually a very interesting paper from the University of Texas at Austin that had done some studies on how news stories influence investor beliefs and therefore stock prices. So I took that idea and that hypothesis and started to test that hypothesis. First of all, can machines read financial news and make sense out of it? And the second is it really a lead indicator of price? And it took 3 years to do all of that, build the algorithms and curate the right type of content, because signal to noise is important. You put in all kinds of content and you're going to get more noise than signal. So once we got there, and Satya was very helpful. We gave our data to Satya. He did a study. We gave our data to Carnegie Mellon, to a professor of finance and his PhD student, and to hedge funds, right? Quantitative hedge funds. And all of those studies came back and said, yes, this AI-derived sentiment seems to have a predictive value. And of course, you can debate whether, we had to do more studies. What is the life of the signal, and is it better for small, mid versus large? And these studies are available. So yeah, we actually, what is called validated this whole construct of investor sentiment. And it was my background in AI and NLP that kind of led me to address this problem. And I think, we're now, using that to do portfolio construction.
And Satya, obviously, you've played around with our data, and knowing that this is an entirely systematic AI-driven process that yields this new factor. How you've also worked on the side with many traditional asset managers. How is this disrupting the traditional asset managers who only look at fundamental factors, who don't really use technology? What's been your experience with that?
Yeah, I mean, I think there's a learning curve here. I think if you go back, I've been at this for a while. I think in the 90s, active managers, it was a culture clash. Either you were a data guy or you were a stock jockey, right? They love the stories, they love the numbers, and they didn't mix. By 2000, 2005, you started to see more of a hybrid. So there's definitely a respect. By today, I think even if they don't believe it, they're claiming that they're very data friendly. So a lot has changed. I do think underneath it all, it gets back to this basic idea or principle of share prices track earnings growth. And we're all after that magic nugget. And I think what Ravi's data does from our test, we build multi-factor models. We have other characteristics that drive portfolios, but the idea of sentiment and trending is a very important vertical in all portfolio construction that we have. And when we performed sort of like a flat test of your sentiment data versus traditional trending business momentum earnings revisions, when we ran it through a battery of tests for the years that we had the data, your model held up remarkably well. And so I can say that you are definitely extracting some bit of information. The other thing, though, is that it is correlated with other traditional trending factors. So it says you're capturing the right thing. And so it's just that can it work a little better, which I think it has, at least in our tests.
Awesome. And I do want to get onto the topic of kind of concentration risk that we're seeing in the market right now. Ravi, obviously, our strategies here at StockSnips are for the most part equal weight strategies. And, even in times of, a market cap weighted tech rally, our strategies seemingly have done very well. Maybe you could shed light on how, a sentiment derived signal when, applied on an equal weight basis is providing some diversification in terms of holdings, and how does that help with concentration risk for financial advisors looking to maybe reshuffle their strategies this year?
The sentiment, the way I look at it is, and the results show it, right? When we analyze and see the last 3 years or the last year, if you look at our holdings, they seem to be sector, style, and size agnostic. Now, we are not influencing, what stocks are getting picked. It's once the models are built, it's algorithmic, and it's driven by this sentiment. And obviously, we are using fundamentals to create different universe, and we are overlaying sentiment, right? So it's the good news is that the signal, which is derived by reading all of this news, is adapting, because that's the only way I can explain why is it that there are certain times where overweight large cap versus mid cap versus small cap, or technology sector versus industrials or energy, right? So it's adaptive. I call it the adaptive asset allocation, and we're dealing with this inefficient market hypothesis that people are beginning to say that, look, fundamentals, and we've done actually a study, right, cross-sectional regression study that CMU did, that measured the returns from sentiment-driven returns from a portfolio, how much of it is attributable to our sentiment signal versus the Fama French 5 factors, right? And clearly, the alpha the excess returns was being partially driven by this. It's not completely driven, and there are times maybe it doesn't contribute, but overall, it is adding significant value. And that's why we're seeing diversifying away from a concentrated set of mega cap holdings. We have not seen, we do get some mega caps, but it's not all the time. And this is definitely, I think, adds value from if you're in the core, and the core is already giving you this exposure to these concentrated, large mega caps. Ours as a sleeve is giving you the returns without that concentration risk.
Awesome. And, Mike, from a broader kind of ETF standpoint, obviously we know concentration risk can be a real challenge. Have you seen any trends in terms of ETF strategies that are becoming available for, maybe financial advisors to tap into to help mitigate this concentration risk away from the, passive market cap weighted indices? How do you think advisors can maybe use some of these strategies in the coming year?
Yeah, so I mean, concentration within the market is very large. And the ETF market is no different. So because the overwhelming majority of the money in the ETF market follows the largest indexes in the world, they just naturally adapt, just like the indexes themselves do the ETF. So if I look and if I look at our ownership data, we do what's called ETF stock intelligence, where we look at a stock level flow rather than hey, large cap flows in the ETF space was X. We actually look at every company that's held in those large caps, and we say, what is the indirect flow to that particular stock based on how it's held? We do that a number of metrics on that. And if you look at that, your Apples, your Microsofts, your Nvidias, they are getting a very much in line. Every dollar that flows into the ETF market is very much in line to their market cap weighting in the S&P 500, et cetera. There's very few outliers. We produce it because the outliers anecdotally are interesting data points to our clients where there is a situation where the ETF market is potentially the tail wagging the dog scenario. But going back to your question about concentration, it's very real in the ETF market. So what are people doing about it? I think traditional active is an example, right? I can go through, some of the largest active management ETFs out there from firms that have the largest distribution teams, therefore they have the largest assets under management. And I can show very distinct differences in their weightings of the Mag 7, right? So that is as an option there, they are making a change, right? I can show that. I can look at their portfolio versus the passive market and say, they've made a choice on Microsoft to be over underweight or security by securities. That is an option. The other way is more what we're talking about here is a factor, right? And I think when I first got to know you guys, and we've been working together now for a number of years, and I've learned more about your strategy, I think of sentiment as another factor. And I think Satya did a really good job talking about what is diversification, because you got to be really careful. I could diversify across sectors by equal weighting sectors, or I could diversify by stocks by equal weighting stocks. There's very differences there. Right? So when I look at the ETF market from that perspective, and I work with advisors, we walk through that understanding of how do you look at that from a standpoint of, is this a fixed concept? Is this equal stock fixed? Is it equal sector fixed, or is it evolving diversification? And that's the big difference. And there's major differences across the strategies, right? If you look across quality strategies or value strategies or momentum strategies or sentiment strategies, there are very, very big differences in how they apply it, right? iShares is notorious with their factor strategies, keeping sectors in line with the market, right? So you end up with some of the same issues. If the market dynamics change, and I say iShares are following MSCI indexes, but they're keeping those sectors where spiders who follow S&P indexes let their sectors float. So concentration and diversification need to be thought in that context. So advisors that we're talking to are saying, look, we want to take our portfolio, our core, and the overwhelming majority of advisors we talk to have a 2 basis point holding for large cap equity, for emerging. That's how they're doing it. And then they're overlaying it, and they're looking for things that evolve, that change, right? So a lot of our tools at our site are designed to show allocations over time. And I can look at your guys' portfolio and look at over the past year, and I can see, how your sectors are changing, month over month, quarter over quarter. I can see, the allocations to that. You're agnostic to value versus growth. You're agnostic, to quality versus value, things of that nature. But that's what the advisors are asking us, and to bring that all into the ETF space, that's where we're seeing the flows go. Right? If you have a strategy in name only, if we can't show in the data that the strategy evolves with the market, the flows don't tend to be going to those stagnant products in the more active space. The flows are going to people that are taking a conviction in the strategy. And we can show that in a number of different ways. We can show it using our classification system. We can show it using our derived analytics that shows concentration or active share relative to broad indexes. And what we see is your big base products continue to get the lion's share there. I think that'll continue for a while. There's that. I don't want to be too different than the market. I want to keep my expense ratio really low. But the winners on that, call it the other 20% of the market that's getting the flows, are those folks that are taking conviction in their decisions. Now, of course, there's risk with conviction, but if you're going to make a change away from the market, that's where we're seeing the flows go. And I think that's why active is becoming such a big story in the ETF world.
Awesome. Now, I do want to wrap things up shortly with a prediction, guys, for 2025 that financial advisors should look out for. But given that we're recording this this week and everything that's gone on with DeepSeek, I think it would be rude to have this panel of experts not touch on that. So there's been some discussions on is the cost that they spent to train this new LLM factual, is the demand for data centers and energy usage here in the US, is that going to stay as predicted? So maybe you could each just chime in with a little bit of thought around this whole DeepSeek saga, what it means for US markets, and more importantly, what it means for investors moving forward. I'll let Satya start with.
Let me start with
Ravi, go ahead.
just the technology, right? Because at a very high level, people understand what large language models are, but what is it that DeepSeek has done, and how do we, understand the impact of that? So if you look at neural networks, they're mimicking the brain. The brain is, supposedly has 2 billion neurons. These large language models, the neural networks they've built, are anywhere from 50 billion parameter. A parameter is a weight in a neural network. Each neuron has a weight, and those weights keep getting adjusted so that you get your prediction right. So now when you're doing training, and then the input is what they call token, a word is a token, a number is a token, right? A formula is a token. So if you look at OpenAI, they trained on 1 trillion tokens. 1 trillion tokens, and then if you take these 70 billion parameters, the computational power required is just massive. What DeepSeek, and even before that, there's another company called, a French company, I think Mistral, what they did is they used a different architecture, which again mimics the brain, saying that you don't need to go through and adjust the weights of the entire 70 billion parameters. If you can narrow down and say, for this input, I only need a fraction of those nodes, that's the innovation. And what DeepSeek did was they took Llama, which was an open source from Meta. They took the work done, which is called the mixture of experts. That's the architecture. That means that you break the neural network down into, instead of one massive network, you have subject matter experts. And based on the input, you only go to that point. And the best way to explain it is, for example, if you're looking at an image, the brain is only activating, your vision and the parts that are needed to understand that image, as opposed to, say, if you're listening to music, it's a different part of the brain. So that triage is happening by, right in the front, so that only some part of that neural, that's what DeepSeek has done. And that's why I believe technologically it's a quantum leap. And it took a bunch of already available open source developments, but they solved some problems in this new architecture, and therefore brought down the cost of efficiency, which is going to have a huge impact on the number of GPUs or the amount of energy you need in terms of creating these new language models, more advanced language models.
Wow, that was I learned something there, Ravi. Great job. I've been trying to read up on this in the last few days just because it's in our face. It did sound a little bit like my undergrad course, a combination of differential equation and linear algebra. That's pretty much, it's all about reduction, right? But a couple of quick things. One, I think we're underestimating the potential usage for these tools as they come online. So I think the investment opportunity is this idea that the need for software analytics to be able to put these tools to use, those are going to accelerate. It's already underway. And the demand for energy, for a whole bunch of reasons, are also likely to climb. The need for data centers will continue to grow. This is a pretty sharp hiccup, but I do think it's kind of like in the 80s, the Russian software guys did not have the memory that the West did. They couldn't afford it, and they became very efficient at coding. That did not mean that we slowed the demand for memory over the next decade. So I think we're underestimating.
I worked on one of those machines, Satya.
Trust me. One of my first courses, the professors decided to punish us with writing our first program with punch cards. And heaven forbid you drop the stack. But part two is this idea about concentration. I got one really cool chart to share with you. It's a little bit counterintuitive, but I think it's a big deal. There we go. So this is what we call, we developed this back in the 90s. It was literally around the internet period. It's called a polarization quotient. It's our proxy back in the 90s for crowding. But what we took a slight different turn was to not just say, hey, did you know 7 stocks outperformed everything else? I don't know if that's useful for predicting how market crowding, whether market crowding is good or bad. However, what we learned from this model is that if you were to take leadership stocks, and this data is only going back to the 90s, we have it going back to the 70s. What we learned with leadership stocks is that basket of, let's say, top 10% of market fast running stocks, their multiples are always at a premium. So somewhere between parity and what's normal in a one standard deviation measure is about a 60, 70% premium. So they normally track this area. What's wild is that in all of this uproar about narrow markets the last couple of years, this model's remained benign. It has kept us out of trouble, out of overinterpreting the noise. Where it's going, though, is that in a short few weeks, this model has climbed to a 56% premium, which is close to that threshold of one standard deviation. So from a concentration standpoint, what we're learning is that leadership can run a lot harder if their earnings are tracking with the capitalization. So what I'm trying to get at is to not separate price trend from the growth of companies. And so if a few companies are just growing faster than the rest of the system, who cares? We're going to chase it. If the multiples begin to exceed some natural boundary, that's really when random events become amplified in share price correction, not unlike Monday. So I think that's our story, is that this market's broadening. The spending on AI will continue. We've got a couple of other indicators that make sense of that, but the idea is that it is a downstream play because at first we were suspicious in 23. So I'm not going to really get in there. I'm going to go with my picks and shovels. It's like the gold miner story, right? Picks and shovels basically meant chips. 2 years later, the commitment to the chips, basically, in order for those firms to monetize those to spending, they've got to turn into applications. So we think that's what's coming, and I suspect you'll spot it in your sentiment data. We're seeing it in our fundamental models as well.
Awesome. And Mike, I know your platform is, uses, I don't even want to guess the compute power or whatever it is to run everything you do. Any thoughts on the DeepSeek situation from your view?
Yeah, so I mean, I'm not even gonna try to compete with Ravi when it comes to understanding the technical side of this, but I think I can maybe provide advisors a little bit of higher way to think about this, a 30,000-foot view. From an investing perspective, just purely investing, the productivity is a big thing that drives earnings growth. There is no question in my mind that productivity is on the rise, has been for a while, and this is just going to accelerate it, whether it's, the AI models coming through to the rest of the market. So you've had your leaders that were there early, they've exceeded it, but everybody's catching up, right? I'm a data analytics platform ran by 7 teams. Everybody on my team uses a chat GPT on a daily basis to optimize our workflows. We're integrating LLMs into our backend to make it simpler for our users to navigate all of the mass amounts of data that come along with the ETF market. And that's going to apply to every piece of the economy. That's good for the economy, that's good for stocks, right? So that piece of the story, who the winners and losers, I think you have to be a little careful with. I think to try and say that only these 7 stocks are going to be the winners of this and everybody else is going to lose, it doesn't make sense. I think time will show that. So with that as a note, I think embrace it. Think of it as a positive from a standpoint of continuing to stay in the market. But my trend, I guess my statement to the advisors out there is none of this changes how important your role is in all this process. The end of the day, the success in the stock market is understanding, having a plan and having the discipline to stay to that plan, right? And there's a lot of people that have capitulated over the last few years in terms of value, in terms of your consumer staple sectors versus your technology sectors, et cetera. And yes, it's been painful if you've not been there. And there are ways. Your guys' tool is one. Your guys' strategy is one to help navigate that. And I would look for those and find it. But if you find it, be disciplined and stay to it. Where you get in trouble in the marketplace is when you allow yourself to think that there's a shortcut. And there's just not. It doesn't matter how much AI there is in the world. Your true value to your clients is your discipline and understanding the long-term story. There's a lot of great strategies out there to help you navigate it, like your guys' strategies, like research from Cirrus. But the reality is, no matter how much noise there is out there, if you allow yourself to get caught up in the day-to-day, how many people, sold because of DeepSeek, right? Your job is to make sure they don't sell. And if you stay true to those principles, you're going to be successful. how that plays into the ETF market. The ETF is just a better tool to continue to implement, just like AI is a better tool to manage large data. So that'd be my large macro theme. And it's not, it's not a prediction. It's just your role in this. And the studies have been done over and over again, suggest that those folks that have an advisor for when it comes to investing, far out their investing experience over their life will far exceed those who don't.
Final message, Rebecca, to the advisors is that at StockSnips, all of this investment we made in AI, as Satya says, right, it's the applications that ultimately will broaden and drive this overall demand for cloud and AI. What we're doing is bringing all of this investment for the benefit of advisors, providing investment solutions, because not every advisor is going to be able to make the kind of investments in all the expertise, the infrastructure. So that's what we're doing, and we hope to partner with the advisors to improve their productivity and outcomes.
Awesome. And I guess, Ravi, that just leads me nicely into, I would like to just ask you all for maybe one thing that in 2025 financial advisors should either be implementing, avoiding, or at least considering. Ravi, I'll start with you.
Oh, tough one. Because I just said markets are non-stationary. So the one thing would be, I would say that, and repeat what Mike said, you have your core, you have your comfort, so you have the exposure to the market. Look for that 20%, sleeve that's going to allow you to take some risk, but also participate in potential rallies without increasing your downside risk.
Awesome. Satya? Oh, you're on mute.
Thank you. I knew I was going to do that at least once in the session. I think Mike's spot on about what he said. The advisor's clients and the advisor, they form the plan. And I think if you're disciplined with that plan, you'll probably come through this fine. I think there is more volatility this year for a lot of good reasons. So that is probably my piece of advice here.
Sam and Mike, finish it off.
Yeah, I think, I've been around for a while in the investing space, and so I've seen things change. And I think my one advice to advisors would be take advantage of the changes in markets, not only the way you go about investing, but take advantage of the tools, whether it be an ETF or other types of strategies, that advancements that have allowed you to be more efficient. And what I mean by that is, the advisors that were early on to adopt ETFs as part of their story, I mean, the data is pretty clear. Those advisors have done really well. AI is no different, right? So if you can find a way to adopt and work with somebody who's using AI to help you build better portfolios for your clients in more efficient ways, seek those out. Embrace change. But going back to my original point, be disciplined, right? So don't make rash decisions. You're end of the day, you're providing that guidance to folks who've spent their life earning money and they don't want to lose it. And they make irrational decisions. It's your job not to, but embrace the technology change, right? We are. I certainly am. I have a bunch of folks younger than me that work for me that do it better than I do. But I know that if you embrace those changes, right, where it used to be, and I'll give you just a very simple example, right? You go back to the early 2000s, the market, take the NASDAQ, right? It went to insanities, the tech boom, and it all came crashing down. There's a lot of folks who made their career in that time period. Those folks that knew that small cap value paired very well with large cap growth, right? And the people that didn't capitulate and held that watched as their big position in large cap growth went to nothing. They redeemed themselves, over and over again over the next few years through that. Well, there's no different than if you go fast forward today, a lot of these strategies that are, identifying these trends in the market, whether it's sentiment or different factors, they're providing you that opportunity. And sometimes it'll hurt. Sometimes they'll get it wrong. But it takes, as long as you stay disciplined and stay with it, if you believe in the strategy and stay on that, embrace that opportunity, because where it pays dividends, it's not every day, but it pays it in big chunks when you need it most, and nobody knows. Like, I don't think anybody had DeepSeek on their bingo card for January of 2025 as what would be a potential catalyst to bring down the Mag 7, but there it was. And that's the whole idea.
Awesome. Well, thank you guys, Satya, Ravi, Mike, for your insights today. I think we've provided a lot of valuable takeaways for advisors and anyone else that's tuning in. I will actually go ahead and link your websites, your contact information, because, you know, Mike, we've been using your platform for many years now. Love it. Highly suggest advisors to check it out. Satya, I know you've got a very exciting upcoming launch that I'll link the webinar to, which I believe is in a couple of weeks. And of course, if you have any questions about StockSnips AI-powered investment approach, I would absolutely love to, you know, go under the covers and explore more of that with you and understand your investment strategies and how we can help. So once again, guys, thank you very much. And until next time.
Thank you.
Thank you.
Thanks.
Thank you. Bye-bye.